What's going on, guys? Today I just wanted to make this follow-up video referring to the three stocks I mentioned in my previous video, AbbVie, AT&T, and Realty Income. That video I talked about how much it takes of each of those stocks to make $100 a month in dividend income. Now today I'm going to talk about another way you can make weekly and monthly income from your stock portfolio. The requirements for this strategy: you do have to hold 100 shares of the equity, and you do have to be approved with your broker to sell this type of option trading. I believe it's level 2 with most brokers. It's just the ability to sell covered calls. So yeah, let's go ahead and jump into it. So this is assuming you own 100 shares of AbbVie, right around $8,500. That's going to cost you today. So, the market has been kind of red today. So it might not be the best day to sell covered calls. Typically, I like to sell on green days, just because the premium will be more. But yeah, let's go ahead and jump into it. So there's a couple things you have to determine. First of all, what you're willing to sell your shares away at. So currently it's at 85. Let's just assume my cost basis is $85, which I believe it is. I just bought them today for this video. So I typically don't want to sell a covered call less than my cost basis, because that means I would be losing money. So I typically like to aim at least above whatever I bought the shares for. So the way the options work, they work on a weekly and monthly basis. So as you can see with AbbVie, they offer a weekly expiration date, which is good, because you can essentially do 4 per month. But yeah. So for this example, let's just go ahead and assume, that we want to choose a expiration date of October 23rd. So it's a little bit more than a week out. So this is on the Thinkorswim platform, but let's go ahead and jump into it. So it's currently trading for $85. As you can see here, this is about a week out. So the premiums aren't real high. The farther you do go out, for example, so this side is the call side, as you can see, and these are the puts. So we're going to be selling, but for example, let's say we selected the $90 call for October 23rd. We would be getting $6. Now, if we went a little bit farther out, let's say November 13th, and let's just say the same strike price of $90, you would be receiving a $65 credit. But you're probably wondering, why is that? It's because it's a farther expiration date, meaning you're taking on more risk as the option seller, because you're allowing the stock price to increase for a longer time. There's more time that it can increase to your strike price of $90, whereas this guy has 8 days. That's it, and this guy has like 29 days. So that's the difference there. But yeah, for this example, let's just say a week out. So we're receiving a $6 credit for AbbVie, and we're pretty much saying that we don't believe AbbVie will go above $90 before our expiration date of October 23rd. So yeah, so let's go ahead and sell that. And we sold it for a price of $6. Okay. So, how are we going to make money from this? First of all, the first thing is theta decay. So as time passes, we're going to make money from this option. Also, if the price drops, we're going to make money, because it's less likely to get back to our strike price. But yeah, that's pretty much the two ways we can make money from this. Let's see. Now, if it does, if AbbVie comes out with some news and it shoots clear up, and you don't necessarily want to get rid of your shares at $90 because you think it's going to go to like 120, you can roll it, and that pretty much just gives you more time, before selling away your shares. So Thinkorswim makes it really nice. They provide you, if you select it, you can clearly roll it here. And pretty much what that's going to do is you're going to buy the contract back for October 23rd. You're going to buy that one back, but then you're immediately going to turn around and sell one for this example, it's a week out, a week longer than this one, but you can clearly go as far out as you want. So that's 29 days out, and yeah, you can see that it's turning into a calendar because you're closing this guy, and then you're going to turn around and open another one. So that is AbbVie. There's a couple other ones that we did. The next one was Realty Income, and we have 100 shares. The difference with Realty Income, they only offer monthly expiration dates, so you can only do this once per month. So let's go ahead and select the November 20th expiration date, and let's just select the $70 strike price. Another thing, different brokers will offer is this percentage right here, and this is the probability that this contract will be in the money is only a 5%. So your chance of profit is at a 95% right now, currently based upon the strike price and what the market's doing. But take that number with a grain of salt, because if the market changes in any direction, that number can drastically change very fast. So it's a good number to analyze, but I mean, don't think that if you're buying a 99% chance of probability that you're always going to win, because that number can quickly change to like 50 or 60% if Realty Income takes off. So let's go ahead and sell this covered call. We are selling it for a credit of 10 cents or $10 for 100 shares. Let's go ahead and review that. We're selling a call for expiration date of November 20th. Okay, that filled. And then the last one was AT&T. AT&T doesn't have a lot of implied volatility, so the premium isn't going to be as good. But let's just go ahead and select October 30th. It's a couple weeks out. And let's say we're going to sell the $30 call. So as you can see here, it's only $4. But AT&T does trade kind of flat, so this is probably a pretty good chance that AT&T is not going to hit $30 in 2 weeks. It definitely can, and if that does happen, then your shares just get called away, and then you'll get your collateral back for those shares. So it'll be around $3,000 you'll get back, and then you can essentially roll it, and then you can start selling covered or cash secured puts. But that's commonly known as the wheel strategy. I'll make another video on that. But for this, let's just go ahead and sell this covered call of 4 cents for AT&T, and it got filled there. AT&T is nice. You can do it once a week, so that's pretty cool. You can be doing these options every week. So it's definitely not a huge amount for AT&T, but these premiums can definitely add up week after week, and over a year, it definitely can increase your return by several $100s or so. So it's definitely another technique you can start using and implementing into your investment strategy. But yeah, always do your research before doing this type of trading. Options are definitely more risky than typically just holding equities. But yeah, I think that's pretty much it for this video. Yeah, thanks for watching.